Earlier in the week, shares in marketing company IZEA Inc. leapt following positive news about contracts with its vendors in a press release. IZEA helps social media publishers connect with marketers to help monetize their online presence. In that press release, the company bolstered its outlook, noting ongoing opportunities resulting from its advances in artificial intelligence and augmented reality. Shares jumped from 175 to 717, thrusting IZEA onto the radar of many more investors looking for the next micro moonshot. But it also caught the attention of skeptics as short interest activity in the stock surged. This story was brought to our attention by the Interactive Brokers stock lending team, whose role is to match investors holding short positions with the right amount of stock to enter and maintain those positions. For every buyer, there must be a seller. Exchanges make this an efficient process through price discovery. It is less complicated for investors to buy stocks than it is to sell short due to additional steps, costs, and even impediments shorting requires. Sellers must borrow shares in the company they want to hold short upon settlement and for the duration of their investment. And as stocks have price discovery, so too does the short side of the market. But that price discovery is to be found in the fee rate, which is the cost paid by a short seller from day to day to hold that position. That's where insight from our stock lending comes into its own. When shares of IZEA popped, so too did trading volume. Before the recent press release, the company was worth $10 million, but that quickly jumped to around $38 million after its disclosure. And for prices to rise like that, there has to be increased liquidity. When some investors see prices spiking, they sell short in the expectation that prices will quickly drop back. Trading volume also surged. Again, before the press release, average daily volume in IZEA was just 200,000 shares. Turnover has reached as high as 21 million shares intraday since. Previously, a short seller would pay perhaps a 3% borrow fee rate to stay short of IZEA. Again, to put the positioning in perspective, only 4,000 shares were held short ahead of the press release. But since then, 500,000 shares have been sold short. And stock lending desks across Wall Street have been scrambling to accommodate their clients by borrowing available shares to lend out. In fact, the stock lending community has reported a huge jump in borrowing costs to as much as 230% annualized. Our own stock lending team notes that resulting demand across the street is sky high. The utilization rate is almost 100%, which means that just about every bit of supply is taken up. That's evidence that the current 53% fee rate may well continue rising. Investors can keep an eye on hard-to-borrow names using social media activity alerts and can watch for names whose fee rates are moving by looking at market scanners, while several lending desks will publish tickers where fee rates are moving actively throughout the day. Thanks for joining us on Traders Insight. For more market commentary, visit us online at ibkr.com/ti.